Hi, everyone. Welcome to the Real Estate Funds podcast. Today we have Isaac Weinberger. He's given real estate investors about 500 million in tax write-offs. Isaac, welcome to the show.
Thank you so much, Weston. True honor to be on the show. I don't take it for granted. I appreciate it. I'm looking forward.
Absolutely. Yeah, so give us a little bit more about your background. And it's just been 3.5 years. You've had some early success here. Give us a little bit more about your background, how you kind of got in this space.
Absolutely. So I always talk about my humble beginnings. I grew up, and my older brother, his name is Zeke. He actually lives in Michigan. He's a restoration guy, and he really taught me how to hustle. We started a lawn mowing business. Then throughout our high school years and college years, we always opened up different businesses, really hustling and learning how to make a buck. And I went to school and I wanted to get into the real estate world. I met a few people. I met my mentor, Ike Marvet, and I was just chatting with him about real estate. I wanted to potentially do finance or insurance. And he said, "Hey, I'm starting a cost seg team. Why don't you join?" I spoke to a few successful people, and they said, while cost seg is a low ticket item, it's the one item, it's the one, I guess, vending space that you could potentially become the guy. Um, let's say financing, there's 20 brokers for every owner. But when it comes to cost seg, you don't have that. You have a lot of pop-up shops, but you don't have so many legit firms out there. And thank God, I haven't looked back. I love what I do on a daily basis, and I think that's very important for whatever somebody does in their line of work, to love what you do. It's not just about making money, it's about being passionate. When you're passionate about the item that you're selling, it sells for itself. You got to believe in it yourself. And I love what I do. I love the events I go to. I love the people I deal with. And I'm grateful for another day to pound it out.
Absolutely. Yeah, so give us a little bit more of the process of how you help people.
Absolutely. So I always start off like this. A few years ago, Trump, I think he tweeted that he paid $750 in taxes, and everybody was up in arms. You trickster, you fraudster, $750 in taxes. The guy's making $50,000 a year paying more than that. You're making millions. And the answer is the way he accomplished that was by doing 1031 exchanges and cost segregation. He owns real estate. When you own real estate, there's absolutely no reason for you to be paying taxes. Now, when I say own real estate, obviously it means you're fully involved in real estate. If somebody's on a W-2 and they just buy some single family houses on the side, they won't automatically be able to go ahead and use those deductions against their W-2. There are ways to maneuver around, but I'm talking about a guy who's full-fledged in real estate. He buys real estate. Um, those real estate assets that he has are essentially a huge, I guess, the tool to offset his tax liabilities. And the way it works is that depreciation. So you buy a property, and a lot of people don't know this because their accountant just does it for them. You buy a property for $1 million, and let's say net of land it's 850. You take off, let's say, 15% for land. That 850 will depreciate over 27 and a half years for residential and 39 for commercial. So let's say residential, you get approximately $30,000 a year in deductions. If you're a real estate guy and you made 30 grand that year, we'll wipe away 30 grand. Um, Obviously, you still have to take off for Social Security and Medicare and stuff like that. But I'm talking about, let's talk about it on a federal level. On a federal level, we'll wipe it away. Um, Cost segregation just accelerates the depreciation. So instead of taking 30 grand a year, you potentially could take 100, 200, 250 year one. And obviously the idea is a dollar today is worth more than a dollar tomorrow. So I always give the parable. If I would see you on the street, Weston, and I would say, "Hey, Weston, remember I borrowed back in high school, I borrowed $100 from you. What would you rather? Me pay you $10 right now, sorry, $10 a year for the next 10 years? Or would you rather $30 right now and $70 over the following 9 years?" Obviously, you would say $30 year one. A dollar today is worth more than a dollar tomorrow. If I could get those tax deductions and put more money in my pocket today, I have more money to reinvest in more real estate
Mm,
tomorrow as opposed to being cash strapped and not having that money. So time value money, that's the whole game of cost segregation.
For sure. And you mainly help. Is it operators who raise money, or is it normal investors themselves?
So what's awesome about my job, it's really everybody. So let's say the way I deal with capital raisers is that I'll sit with them and say, hey, when you're pitching the deal of the sponsor to a potential investor, talk about the potential cost seg benefits. For every $100,000 that you invest, you potentially could get back $70,000 in losses. So you're not really all in for 100 grand. You're all in for 100 grand minus the depreciation you'll get. That's the way I deal with capital raisers. The way I deal with the actual GPs, the sponsors, they're the one that are signing off on the docs. I'm convincing them why Isaac is the best, why our company is the best, how we'll push the numbers, and we'll do the greatest job. And then I deal with that's more on like a syndicator level. Then I deal with single family guys. So you have a guy who owns a bunch of single family stuff. There's no partners. Boom, he's going to get the full deduction. He doesn't even have to break it up. Then I deal with let's say healthcare facilities. So I deal with the operators a lot of times. There's the real estate aspect, there's the business aspect, but there's so many different avenues. It's not just like, oh, debt or investment sales where you're always headed to the same guy and the same style. There's so many different asset classes that can benefit. Every asset class benefits from cost seg, but it's just there's so many different nuances, and I love that
Yeah.
aspect of the
Yeah,
space.
and talk about the different asset classes that you deal with and what you see, investors go with. Because, I have a guy right now, I won't mention his name, but he's selling a business and he has a huge capital gains. He's looking for something to put his money into, get some tax write-offs. Talk about the different asset types you deal with and then the benefits, maybe pros and cons of each.
Absolutely. So no two assets are created equal. I'm actually hosting a webinar with some of my hotel clients and talking about why hotels are one of the best asset classes for depreciation, and I'll explain that in a second. But let's start with the most lucrative asset classes for depreciation. So car washes and gas stations, and obviously disclaimer, car washes and gas stations and hotels are all in the business, I guess, sector. They're not fully real estate. There's a business component, healthcare as well. But gas stations and car washes get almost the entire thing. That's a law that was created
And
that
that's year one.
that's year one, almost the whole thing. Now, obviously, bonus depreciation phased down a bit, so you're going to get a little less. But the idea is you purchase a gas station for $1 million, and at least half of the revenue is coming from fuel. You'll be able to get most of the purchase price net of land as a write-off year one. Same goes for car washes. Um, then the next asset class, which is actually real estate related, is, and by the way, don't get me wrong, you got to own the real estate of the car wash and the gas station. A guy called me up 2 weeks ago. He's like, hey, I bought a car wash for 2.8 million bucks. Want to do a car seg? I'm like, great. And it came out afterwards. He didn't buy the real estate. He just bought the business. So the only way to get the write-up is if you buy the real estate as well. RV and mobile home parks. RV and mobile home parks get a tremendous amount of depreciation. We're talking about anywhere from 40 to 85% of the purchase price, depending on the situation, how many
Mm.
park-owned homes, tenant-owned homes, utility structures. There's so many different aspects to it. But you could get sometimes 40 to 85%, depending on the situation. The next asset class is hotels. The reason why hotels get a lot, and by the way, just to go back to mobile home parks, the reason why they get a lot is because there's really no structure. Even the actual walls of the mobile home, a lot of times the IRS will consider that non-structural. So if it's non-structural, then you could take a lot of it earlier on. The whole idea of a cost seg is to seg out, to take out the non-structural from the structural. So to separate the two. So by mobile home parks, you don't have a lot of structural. By hotels, there's a lot of FF&E, furniture, fixtures, and equipment. So you get a lot of benefits there. There's pools, there's tennis courts, there's pickleball courts. All these land improvements get a tremendous amount. So hotels are a great asset class, anywhere from 30 to 50%. I would say 25 to 50% of the purchase price net of land. Then the next greatest asset class is garden style multifamily. So obviously we know the difference between a garden style multifamily and a city walk up multifamily. You go to Manhattan and you have a city walk up multifamily, you're going to get much less because there's no parking lot, there's no land improvements, there's no common areas. As opposed to a garden style in Arizona or Texas, and obviously Weston, you know the space very, very well there. You can get a lot more. You got courts, you got swimming pools, you got common areas. So you can get anywhere from 25 to 40%. As opposed to a walk up, you're going to get more in the 15 to 20% range of purchase
Hmm.
price net of land. Then same idea goes for single family garden style versus city walk up. If you have a Newark single family property with no driveway, you're going to get much less. But if you have a beautiful property with a swimming pool and a basketball court and an acre of land, you're going to get much more. So, and then it goes to retail strip centers. Retail strip centers are very dependent on how big the parking lot is. So parking lot is a big component for cost segregation. It's called 15-year. It's land improvements, which is pavement. So if it's a huge parking lot, you get more. If it's small, you get less. It ranges between 17 and 25% generally, or sometimes a little more. Then people come to me and they're like, "Hey, Isaac, I have a warehouse." I send them a proposal and it comes back 12% net of land. And they're like, "Isaac, dude, you got to get me a higher write-off." I'm like, "What do you want me to do for you? There's no carpet, there's no flooring, there's no cabinetry, there's no special equipment, there's no nothing. A warehouse and a self-storage by nature, and that's why they are warehouses and self-storage, there's nothing in them. So they're hollow. So if you have a huge parking lot, you can get much more, but generally there's much less to depreciate by a warehouse and self-storage. That being said, there have been situations where there's special equipment, special freezers and warehouses and stuff like that the tenants put in these special medical freezers. You could get more. Whatever's there, we will find and we will get. But we deal with what you give us. So the more items and the more non-structural components that are there, the higher deduction you will get. That's the way it works. And then there's
Hmm.
medical facilities and office. That's also similar to retail. But I think we covered most. I think we covered all the asset classes. Um, Most of them. That's the idea. The idea is
Yeah.
the more non-structural stuff, carpet, flooring, all those stuff, bigger parking lots, the more deductions you'll get.
Hmm. Yeah, the more equipment, the more deductions. Um, yeah, so it seems like when you start, you mentioned car washes, gas stations. It seems like the more equipment there is, maybe the more risk. So talk about, in terms of the risk investors should expect between, car washes, gas stations, and maybe lower risk like triple net, multifamily, stuff like that.
Absolutely. So for sure, when there's more machinery and stuff like that, you're dealing with higher ticket items that definitely go faster. And I think that's part of the reason why um, the government considers them items that depreciate faster because these a big part of the purchase is this equipment and they go bad. So they want to give you the write-offs to try to as if compensate for what you're losing out on. Um, but let's see, triple net. I love triple net because you don't have to deal with it. And a lot of times, doctors and surgeons and all these guys, they'll buy triple net properties because they don't have to deal with it. No management, because the tenants deal with all the improvements, tenants deal with everything. And then when the tenants leave, it could be after 10, 15 years, they get to keep, hopefully, they keep them for life, but they get to keep all the improvements that they did. But they don't have to deal with all the day to day management, the day to day issues that a property could have. But I'm a big fan of triple net. If I buy something in the retail sector, I definitely want to buy something triple net.
100%. Yeah, what do you expect the write-offs to be year one for a triple net?
Triple net is the classic regular retail strip center. Um, you can get back anywhere from 15 to 30% depending how big the parking lot is, depending if there's any special equipment inside the stores. But yeah, it's a classic retail strip center that you'll get 15 to 30% depending on the situation.
Mm.
Just a side note, many people don't know this, but a brick building will get less than a non-brick building. Brick is automatically structural, but when you have stucco, when you have different types of whatever it's called, sidings and stuff like that, that is easier. It's easier for us to consider that non-structural. So sometimes you get a little more. So a lot of times a guy came to me and he said to me, Isaac, you got me 25% last year, and this year you got me 23%. I'm like, hey, look at the building. One was brick, one wasn't brick. I was like, that's the answer. And he was like happy. He's like, I just want to understand, like, hey, what's the difference? But there's so many nuances. It's not just like black and white. They're like, it's in the title business or in the debt business. It's just like, okay, the rates are this today for this and this style property for this and this amount of vacancy. This is the amount of LTV we can get you. But over here, no two buildings are created equal because this guy has a drop bigger parking lot, drop more this, a drop more flooring. So nothing's ever going to be exactly the same.
For sure. Yeah, what's your suggestion regarding investors maybe after they sell a business, they want to build their portfolio for real estate. They have all these different asset classes, different types of returns, different types of write-offs. What do you suggest in that regard?
I'm a big fan of real estate. People all the time like, hey, why don't you play the stock market a bit? I think it's just might as well take your money to the casino, unless you're just throwing it into a safe stock and just keeping it there. But somebody who's really playing around the options and stuff can get tricky. But real estate I love so much. I love triple net properties. Obviously, multifamily is great, but don't just go for the low hanging fruit. That's my advice. I think that there's a lot of good stuff out there, um, and there's a lot of shiny objects out there. And if you go ahead and you don't just brokers market great properties, but if you put the real work in and you sit there cold calling, and you find the family-owned properties that you could get at a discount, they're looking to offload them. I just spoke to a guy. I tried to on the side broker some stuff. A guy owned a bunch of properties for I don't know 15 years, and I have a friend that's buying a property from him. He's going to get a good deal. He worked hard. He looked for the right deal. Obviously, the better the price, the better the cap rate, the better the property is going to perform. Don't just go for like the easy ones. But yeah, I love triple net. I love multifamily. I love mobile home parks and RV parks. I love hotels. Hotels are tricky because it's a real business. You really have to be real boots on the ground, day to day. But some great asset classes out there.
Hmm. Yeah, so talk about what your thoughts are between doing deals yourself versus with an operator, maybe more passive investment.
Absolutely. So, um, obviously, a passive investment, if you're just going to write a 50, 100, 200, $300,000 check to a syndicator, it's easy. You have a guy that's been doing deals for 10 years, 20 years, 5 years, and they've been doing well, and they promise you a 2.5 equity multiple, and looks good. And if they've been doing well, you'll probably do well with your money. Happens to be today's day and age. It's a drop trickier, like you know. Um, People are under a lot more scrutiny than before, just because they did stuff in 2020, 2021, and took floating debt, and things didn't pan out the way they wanted it to. So people are under the fire, under the gun a little bit more. But I think if you don't have any time on your hands, passive investing is not a bad opportunity. Also, triple net is not a bad idea just because you don't have to manage it. Or if you buy something and you offload it to a property manager that you can trust that potentially has a little bit of skin in the game, so he treats it like his baby. Um, but I always tell people I think my personal opinion is if you could do it yourself, do it yourself. Um, you'll call the shots. You'll pull money when you want to pull money. Um, you're not reliant on somebody else's decisions. Um, that being said, you have to have the capacity to deal with it. You have to have the brain to deal with it. You have to know a little bit. You have to read books. You got to listen to podcasts. You got to do you got to do the right things in order to make sure you're not going to screw up. But definitely, if you could own and manage yourself, do it. But if not, there's a lot of great opportunity out there to invest with big time syndicators, um, or buy properties that you don't have to deal with on a day to day basis.
For sure. Yeah, and you can be flexible in terms of when you buy, when you sell. Well, you can buy whenever you want in a syndication, but they ultimately control the sale. But yeah, you do have to have the expertise to do that. Yeah. So what do you personally invest in? Because I saw you also invest yourself.
So far, it's been passive investing. God willing, going to get involved in on the GP side soon. Just smaller single family stuff. But then hopefully down the line, syndicate some deals. If I have create some time for myself. But I look at OMs the whole day of my clients and definitely get involved, try to broker some equity, help them out. Um, but thank God I've learned the game and I love it. It's real estate's fun as you know it.
Yeah. So is that your plan moving forward to move to the GP operator side?
I don't think I'll move to it. I think it's just going to be a hybrid. I love what I do. I don't think I'm going to give it up too fast, but if I could own some properties on the side, I'd happily be busy with both.
For sure. Yeah, and it seems like you kind of taken the role as the main guy in the cost seg space. So talk a little bit more about how you did that.
I appreciate that. I like that question because I think this is an opportunity for folks starting in any area of any business to to really learn from this. So obviously I put in a lot of hard work. I did a crazy amount of work, and God really helped me out a lot. It's been amazing. Um, the heart Kyle Matthews from Matthews Real
Yeah.
Estate told me something. I met him by the ICSC in New York last year, and he told me something that really stuck with me. He said, Isaac, if you want to be the 1% of the 1% in terms of what you make, 1% of America makes 500,000. 1% of that 1% makes $2, $3 million a year. You want to be that 1% of the 1%, do what the 1% of the 1% do to get there. Got to wake up early, go to sleep late. But on top of that, I try very hard to provide value to my guys. I talked about brokering properties, brokering equity. I never charge for any of this. If I could go ahead and hook up a guy with this guy and he's potentially selling something, this guy's looking to invest in a deal and he wants this style deal, I'll happily do it. So really genuinely providing value to your guys and showing your guys that you're interested in them and you're not just interested in their money, you're interested in actually helping creating a real relationship, um, and doing things together. That's where success comes from. Um, just putting in the work every single day, providing value, being honest. Being honest is a huge thing I talk about all the time. It's so easy to get sucked down and to trick a guy and to fool him into this. I have many emails telling me, "Hey, Isaac, send the DocuSign," and I'm like, "Hey, I don't think it makes sense for you." Um, just being honest, providing value, putting in the hard work, leaving the results on the floor, leaving it up to God. To There's nothing I could really do if he decides that he doesn't want it to happen, and that's it. Put in an honest day's worth of work. LeBron always says, he said, if I put in a good game and I wake up early, I come to the gym a few hours before, and I play a great game and I lose, I'll live with it. I'm fine with it. I can live with the results. But if I know that I went to sleep late the night before, and because of that I was groggy and I couldn't really practice well, and therefore that resulted in not the best game, and therefore we lost, I'll be upset at myself. If you put in the
Hmm.
hard work, leave the results on the floor, you'll be satisfied.
100%. It's a lot to take away there. Yeah, so talk about your how you built your audience because you're on LinkedIn, you're on different social medias, you also have a podcast. Talk about how you built that up over the years.
Absolutely. So again, a lot of work, a lot of genuine engagement on LinkedIn with people and showing them that I was interested in their content, and then obviously they reciprocated. Um, just putting out valuable content, really learning the space, talking and posting updates and cost seg situations and case studies and showing my fun side of things, going to games and just taking out clients and just having fun made people interested. And thank God I built up to 20 plus thousand followers, and I get some nice traction. I get a lot of leads off LinkedIn. I got a lot of incoming DMs. Hey, Isaac, can you run a proposal for me? I'm missing this property. And then we take it offline, create a relationship, help each other out. So it's it's just been a journey the past couple of years on LinkedIn. I love it. It's work. It's not easy to just engage and really read through posts and show genuine interest. So I like it though. I've learned to like it, and it's given me a lot. It's given me 80% of the business that I do is generated from LinkedIn.
For sure. Yeah, it's a great platform too. And a lot of the operators and real estate investors are on there. Do you just do content or do you also do outbound as well?
Do I, sorry, I missed that question.
Yeah, so do you just get people coming to you through content or is it outbound as well?
I definitely do outbound as well. A lot of times, like I was on a call this morning with the CPA. I did work for his client. I called him, hey, you have other clients we could work together on. I definitely reach out. In my early days, I made 300 cold calls a day for 6 months straight. So I definitely do outbound still now. I'll follow up with my guys. I don't give up on guys until they actually tell me no. And even when they tell me no, I'll come back the next time. Hey, I want another shot. So I definitely put in that work and a lot of outbound. It's not just, oh, inbound 30, 40 leads a day for sure not. But here and there, definitely things come in. So I get referrals and stuff like that.
For sure. Yeah, referrals come from good business.
Yeah,
Yeah, so
thanks,
one
man.
last question, Isaac. What's your number one tip for real estate investors?
My number one tip is I love that question because I have a podcast and eventually we'll have you on. But yeah, I asked this, what advice would you give real estate guys, new guys? Um, First of all, first and foremost, jump in. People, there's back and forth. Should I do this? Should I not do this? Obviously, it has to make sense, but there's going to be a risk to everything. Nothing's ever going to pencil out 1,000%. Jump in, be honest. There's so much opportunity not to be honest, um, and work hard. So work hard, jump in. Don't just go for the shiny objects. Go for the good ones. Sit there cold calling. Look for the off market properties that you're going to get a discount on. Work hard. Don't just go for the easy ones. Oh, this broker will just quickly we'll raise the money. We'll figure it out. No, go for the ones that you're going to get a steal. You're going to work hard in the beginning, but it's going to pay his dividends as time goes on.
For sure. Yeah, so how can people get in touch with you, Isaac?
A friend of mine told me the other day. He messaged me on WhatsApp and then he messaged me on LinkedIn and I answered on LinkedIn. He's like, "Oh, I think I'll just start messaging you on LinkedIn. It's easier to get through to you here." But my phone, my email, Weinberger at Madison Specs. You can put that out to all to the audience, and my phone number as well. And then LinkedIn. Connect with me on LinkedIn. DM me. I'd love to chat with each and every one of you, explain to you on a personal level how your caustic situation could potentially look. Um, yeah, absolutely. It's excited.
Awesome. Well, thanks for coming on, Isaac.
Thank you so much, Weston.